Okay, so we are seeing some positive action as we start the new trading week. One would have to assume that there's going to be a lot of attention midweek on the latest inflation numbers in the United States, since sticky inflation has proven problematic for central banks, including the U.S. Federal Reserve. And up until recently, expectations for rate cuts had started to weaken. And then all of a sudden, over the last couple of weeks, people started talking about it again. I want to talk to Phillip Colmar, managing partner at MRB Partners, for his take on how much of that dialogue is influencing the stock market right now. Phil, great to have you back with us. First of all, on the inflation front, what are your own expectations for what we see in the latest CPI this week?
I mean, well, month-to-month CPI can be pretty choppy, but I think the underlying trend is pretty clear. We've got a lot of resilience here in terms of CPI, or stickiness, as we'd call it, particularly in the areas that matter to the Fed, which is that super core services ex shelter kind of inflation. That's being pretty problematic. And it's at a point when you've got the U.S. output gap, if you will, or the economy growing above trend, not a lot of slack. So month-to-month inflation could be wonky, and the Fed is pretty clear that it'll take full advantage of any soft print, and you're bound to get one or two over the next 6 months. It's just the trend is still going to be sticky inflation, and we're not heading back towards that 2% anytime soon. So that becomes problematic as the year progresses ongoing for the Fed. Okay, so I guess for your own, as an investor, how are you thinking about what happens with interest rates in the U.S. this year? Well, we've thought that the Powell's probably made the big mistake in assuming that it's restrictive. Everything in the economy is telling you that we're not on the restrictive side. And so the real key there is, if you're restrictive, then time should work against the economy. It should start to weaken the economy. It should create disinflation. The market wouldn't be rallying the way it is if we were really on that side. But if you're not, and you're more accommodative, then the Fed's making a mistake in the sense that we're still going to continue to grow above trend. Inflation is going to be sticky. And so the Fed wants to jump on rate cuts, and it may get a window where it gets one, maybe two, if we get a couple of soft inflation prints. But the problem is if you're still accommodative and the economy is growing above trend, well, then on the balance of the year, the Fed's going to have to rethink its strategy. The market's going to have to rethink it. And so while you might get one or two, which we deem as a mistake, the Fed's going to have to rethink the other way by year end. And so that's going to keep, for the near term, probably bond yields will remain calm. And that'll be key for equities. That's the green light for equities to rally. But as the year progresses, if there's any expectations that inflation's stickier, then that's problematic for equities. Sort of like we saw in a taste of April here, where inflation was sticky, bond yields rallied, and equities took it on the chin. Okay, maybe give us a little bit more on the bond yield story and why having a stable yield story in the fixed income world can be helpful to the equity market. So right now you've got an environment where the economy is actually okay and earnings are good. They're beating modestly to the upside. Margins are still solid. So earnings are not really your threat. And actually a lot of the rally has been contributed by earnings improving here. So earnings are a good thing. The problem is a lot of the rally was predicated on earnings improving, but your rate cuts and bond yields coming lower. And so as long as bond yields can hold sideways, earnings can carry the day and equities are okay. And it actually means a broadening to the equity market is fine. But if bond yields start to come higher because inflation expectations are stickier, perceive that the Fed's job's not done, well, now you're getting strong earnings, but it's being offset with a higher discount rate. And that's what we ran into in early April. And that's really where it runs into danger. You've already priced in okay earnings, and now you're having to deal with that higher discount rate. So as long as bond yields, which they are right now, is going sideways, that's actually pretty good for equity environment. It's still a risk-on environment. It's a green light to risk on. It actually means a broadening of the equity market beyond some of your leaders into some of your other groups. Yeah, and what are the groups you're eyeing most right now? Yeah, we think in this environment, U.S. large cap financials are particularly well poised for it. Less so the regional banks, because they do have some commercial real estate exposure. If bond yields surge higher or move again higher as the year progresses, that might be problematic for the regionals. But the large cap financials look good in the United States. Some of the industrial space, like aerospace and defense, looks appealing. Energy looks particularly appealing in a world where the global economy is improving, the trade cycle is improving. And then regionally, we would be favoring Europe, Japan, emerging Asia. Euro area, Japan, emerging Asia. Within Canada, though, the difference would be is the financial sector is right now bond yield stable. That's okay. It means further okayness, okay for the financials, but underperformance, which they've been doing. But if bond yields were to go higher, that's really problematic because at the cutting edge is that mortgage debt servicing burden, and that becomes really threatening to the financials. So financials are at best an underperformance play within Canada, and more likely eventually an absolute deterioration play or a loss play, if you will. Well, you've talked a lot with us over the last couple of years about your concerns about Canada's housing market.
for the banks themselves, is it a concern that maybe you have to increase your loan loss provisions? Is it a concern that if things get more choppy in the housing market, that they can't originate as many mortgages and all banks are looking to grow through loan origination and stuff like that? Is it a combination? Is it something else?
So right now, as the underperformance play, it's difficult to trade as many loans when the consumer sector is pretty tapped out. Already has a lot of leverage, so it's difficult for it to take on the same kind of leverage that you have the capacity in the U.S. or Euro area to do. So the better bank plays are outside of Canada. The bigger problem is that a lot of that mortgage debt, as it becomes reset in terms of interest rates, we're already seeing a lot of negative amortization on some of the major banks. We're seeing an extension of the duration to pay off those mortgages, those kind of things. So there's problematic, there's fragilities in the banking system that's trying to be hidden, and the idea, hoping that bond yields eventually come down and kind of bail it out. But those stress points are already pretty evident. And so if bond yields, the 5-year mortgage rate continues to rise and the Bank of Canada doesn't cut, we think it will ultimately have to provide an offset at that point. But if it doesn't, then you end up with a lot of strains on the banking system. And so you end up with not just less loan growth, but then you end up with a collateral issue. You end up with the loans that have already been there, whether they can be serviced properly, whether there's more bad debts. So there's just a lot of risk around Canadian banks that you don't find elsewhere.
And then just a final question we showed for our television audience, some of the different areas you're watching. Just to reiterate, you like the larger U.S. financials, you're cautious on the Canadian ones, but energy and industrials are groups you like. But globally, you're watching Europe, you're watching Japan, you're watching emerging Asian markets as well. How common is it for you to go that far afield in terms of geographic strategy?
We're a global multi-asset investment shop, so we do have a global multi-asset recommendations and portfolios. The key here, though, is that when you start to see earnings broaden, right now what you're seeing is the trade cycle pickup, so manufacturing and trade pickup, and that's usually a key for non-U.S. earnings. So as much as pockets of the U.S. we like, that's actually where investors start to feel more comfortable about earnings abroad, looking for lower valuation growth plays, and so Euro area fits in that bill. Japan, which has kind of ended its period of secular stagnation, new dynamic going on, looks appealing. And emerging Asia tends to be at the front edge. We're already seeing the trade cycle start to pick up there. Less so to do with China, but the rest of emerging Asia. So our recommendations would naturally go that way, but it's predicated on the fact that global growth is looking more resilient, trade cycles picking up, the manufacturing cycles looking better. So those kind of things help the earnings or relative earnings stories for those markets.
Okay, Phil, thanks.